last giant has fallen. China Vanke, once the untouchable titan of Chinese real estate, the developer that survived when Evergrande collapsed, when Country Garden crumbled, when dozens of others disappeared into bankruptcy, has just announced a loss so catastrophic it's sending shockwaves through the entire global economy. We're talking about an $11.8 billion loss in 2025 alone. That's 82 billion yuan vanishing into thin air. But here's what should really terrify you. This isn't just another developer going down. This is the developer everyone thought was too big to fail, too connected to fail, too state-backed to ever fail. And if Vanke can fall this hard, then nothing in China's property market is safe. If you want to understand just how deep this crisis goes and why it matters to everyone everywhere, hit that like button and subscribe, because what's happening right now in China is going to reshape the global economy in ways most people aren't even beginning to comprehend. Let's put this loss into perspective. $11.8 billion. That's more than the GDP of some countries. That's enough money to build entire cities. And this isn't Vanke's first year in the red. In 2024, they lost 49.5 billion yuan. So over just 2 years, Vanke has hemorrhaged roughly 131.5 billion yuan. That's over $18 billion gone. For a company that in 2020 was making profits of 41 billion yuan, this collapse is almost incomprehensible. We're watching one of the most dramatic corporate implosions in modern history unfold in real time. But what makes this even more shocking is how quickly things deteriorated at the end. During the first 3 quarters of 2025, Vanke lost approximately 28 billion yuan. Painful, yes, but manageable compared to what came next. In the 4th quarter alone, they lost an estimated 54 billion yuan. Think about that. Nearly 2/3 of their annual losses came in just 3 months. Something catastrophic happened in that final quarter. The property market didn't just decline, it accelerated into free fall, and Vanke got caught in the downdraft. So what exactly went wrong? According to Vanke's own earnings forecast, they're pointing to a sharp decline in what they call settlement scale and persistently low gross margins. Let me translate that from corporate speak into English. Settlement scale means the actual delivery of properties to buyers and the recognition of revenue from those sales. When that number drops sharply, it means fewer people are buying homes, and the homes that were bought years ago are finally being delivered at prices that no longer make economic sense. The gross margin problem is even worse. Vanke has been delivering projects in 2025 that were built on land they acquired before 2022, when land prices in China were at absolutely insane levels. Here's how bad it got. Between 2018 and 2021, when China's property market was still booming, Vanke went on an aggressive expansion spree. They were buying land like it was going out of style, paying premium prices because everyone assumed property values would just keep climbing forever. That's what always happens in a bubble, right? Prices can only go up. Except they don't. When the market turned in late 2021, Vanke suddenly found itself sitting on massive land banks that they'd paid top dollar for, and now they had to build on that expensive land and sell apartments into a market where prices were collapsing. Imagine buying ingredients for a restaurant when prices are sky-high, then being forced to sell your meals at a massive discount years later. That's exactly what's happening to Vanke. They're stuck delivering properties that cost them a fortune to build on land that cost them a fortune to buy, and they're selling them at prices that guarantee losses. Every project completion is another financial bleeding wound. And they can't just stop building because Chinese law and regulations require developers to complete projects they've already started and taken money for. They're trapped in a doom loop of their own making. Now, let's talk about the elephant in the room, Shenzhen Metro Group. This is Vanke's largest shareholder, a state-owned entity that owns about 1/3 of the company. For nearly 2 years, Shenzhen Metro has been Vanke's lifeline, pumping cash into the developer like a constant blood transfusion. By November 2025, they had provided nearly 30.8 billion yuan in loans. These weren't normal commercial loans either. They were coming in at interest rates below market, about 2.34%, which was the one-year loan prime rate minus 66 basis points. It was cheap money meant to keep Vanke alive. But here's where things get really interesting. On November 2nd, 2025, Shenzhen Metro dropped a bombshell. They announced they were capping any further financing to Vanke at 22 billion yuan total, and they were demanding collateral for everything, including the 20.37 billion yuan they'd already lent on an unsecured basis. This was the moment the market realized that even state backing has limits. Even Shenzhen Metro, backed by one of China's wealthiest city governments, was saying enough is enough. They couldn't keep throwing money into a bottomless pit. Think about what this means. This is a state-owned enterprise, directly controlled by the Shenzhen government, telling one of China's flagship developers that the free money tap is being shut off. This isn't some private equity fund cutting losses. This is the Chinese state essentially admitting that they can't save everyone, that maybe they won't save everyone. The signal this sends to the market is devastating. If Vanke can't count on unlimited state support, who can? The collateral demand is particularly brutal. Shenzhen Metro is saying we want real assets pledged against these loans, and if you don't provide them, we have the right to demand immediate repayment of everything. For a company already drowning in debt, this is like being told you need to start swimming with weights tied to your ankles. Vanke scrambled to provide collateral, but the damage was done. The market now knew that Vanke's biggest supporter was backing away. Let's talk about Vanke's debt situation because it's absolutely mind-boggling. As of June 2025, they had 364.3 billion yuan in total interest-bearing debt. By September, their short-term borrowings and current portions of long-term debt totaled 151.4 billion yuan. But they only had about 60 billion yuan in cash. You don't need an MBA to see that math doesn't work. They owe more than twice as much in short-term debt as they have in cash, and that's assuming all that cash is liquid and available, which it almost certainly isn't. This is what's called a liquidity crisis, and it gets worse. Vanke has been desperately trying to extend bond payments. In late November 2025, they asked bondholders for permission to delay repayment of a 2 billion yuan bond that was due December 15th. This was the first time Vanke had ever publicly sought a bond extension, and it sent their bond prices into absolute freefall. Several of their yuan bonds dropped more than 20% in a single day. Some plunged over 30%, triggering trading halts. Their dollar bonds, which had been trading around 55 cents on the dollar, crashed to below 40 cents. The market was screaming one word: default. Credit rating agencies weren't far behind. S&P Global downgraded Vanke to selective default, saying that the bond extension attempts constituted distressed debt restructuring tantamount to a default. Fitch Ratings slapped them with a restricted default rating. These aren't minor downgrades. These are the ratings you get when you're already in default or about to be. For international investors holding Vanke bonds, this was a disaster. For Chinese investors who had been told that state-backed developers were safe, this was a wake-up call that nothing is safe anymore. And Vanke kept trying to extend more debt. They sought to delay a 3.7 billion yuan note due December 28th by a year. On December 31st, they announced they'd be holding another bondholder meeting to vote on extending a 1.1 billion yuan bond due January 22nd, 2026. This is their third extension attempt. At some point, you have to ask, how many times can you keep kicking the can down the road before you run out of road? The answer appears to be, not many more times. Here's what's really scary about Vanke's bond troubles. According to S&P Global, they have more than 9.4 billion yuan in bonds maturing in the next 6 months. They've got dozens of bonds outstanding, both domestic and offshore, totaling over $50 billion when you count everything. We're not talking about a company with a small debt problem. We're talking about one of the largest corporate debt piles in Chinese history, potentially going into restructuring. If Vanke defaults on a significant portion of this debt, it would dwarf the defaults we saw from Evergrande and Country Garden. This would be the biggest developer default yet, and it would come from a company everyone thought was financially stable. The broader Chinese property market context makes this even more terrifying. Home prices have been falling for 29 consecutive months as of November 2025. That's nearly 2.5 years of non-stop price declines. In November alone, new home prices across 70 cities dropped 0.4% month-over-month and 2.4% year-over-year. That's the steepest decline since August, and it's accelerating, not slowing down. Only 11 out of 70 cities saw any price gains at all. Looking at specific cities, Beijing saw new home prices fall 2.1% year-over-year in November. Guangzhou dropped 4.3%. Shenzhen fell 3.7%. These aren't minor markets. These are China's biggest, wealthiest cities, and even they can't stop the bleeding. Second-hand home prices are falling even faster, down 5.8% in top-tier cities. When people who already own homes are seeing their property values collapse, they're not going to be rushing out to buy more properties. Consumer confidence is shattered. The sales numbers tell the same grim story. New home sales from China's top 100 developers plunged 36% in November 2025 compared to a year earlier. In the first 11 months of the year, home sales shrank 19% overall. S&P Global projects that total new home sales in 2025 will be between 8.8 and 9 trillion yuan, down about 8% from 2024. That might not sound catastrophic until you realize that in 2021, sales were 18.2 trillion yuan. The market has literally been cut in half in just 4 years. And it's not over. S&P expects sales to fall another 6 to 7% in 2026, with primary home prices down another 1.5 to 2.5%. Other forecasts are even grimmer. The market isn't finding a bottom. It's still searching for one, and every time you think it might stabilize, it falls further. This is what happens when a bubble this big pops. It doesn't bounce back quickly. It deflates slowly and painfully over years. The inventory situation is absolutely out of control. As of August 2025, there were 762 million square meters of completed but unsold housing sitting empty across China. That's up from 753 million in December 2024. Think about what that means. Hundreds of millions of square meters of finished apartments with nobody to buy them. These aren't projects under construction. These are finished, ready-to-move-in apartments just sitting there gathering dust. The supply overhang is massive, and it's going to take years to work through even if demand recovers, which is a big if. The Chinese government has been trying everything to stop the collapse. They've lowered interest rates. They've reduced down payment requirements. They've relaxed home purchase restrictions in major cities. They've created white lists to fund unfinished projects. They're even considering nationwide mortgage subsidies for first-time buyers and increased income tax rebates for mortgage holders. But here's the problem. None of it is working. When consumer confidence is this broken, when people have watched property values collapse for years, when they've seen major developers default and leave projects unfinished, they're not going to rush back into the market just because interest rates dropped a bit. This is a crisis of confidence as much as a financial crisis. Chinese households have traditionally kept about 70% of their wealth in real estate. For decades, property was seen as the safest, most reliable investment. It was how families built generational wealth. It was how parents secured their children's futures. Now, millions of Chinese families are watching their primary store of wealth evaporate. They're seeing their apartments worth 20, 30, 40% less than what they paid. Some are underwater on their mortgages, owing more than their homes are worth. This isn't just an economic crisis. This is a social crisis. And Vanke's collapse makes it worse because Vanke was supposed to be different. Vanke was founded in the 1980s in Shenzhen, rode the wave of China's economic boom, became one of the country's most prominent property companies, and maintained a reputation for financial prudence. They were the boring, stable, well-managed developer. They didn't take crazy risks like some of the other guys. They had state backing. They had Shenzhen Metro as a major shareholder. If Vanke can fail this spectacularly, it tells every potential homebuyer in China that no developer is safe, that state backing doesn't guarantee anything, that the whole system is more fragile than anyone thought. Let's talk about what Vanke has been doing to try to survive. Since the second quarter of 2024, they've been streamlining non-core operations and seeking asset disposals. Translation: they're selling anything that isn't nailed down. In the first half of 2025, they achieved 5.75 billion yuan in recovered funds from asset revitalization. They signed large-scale transaction deals worth 6.43 billion yuan. They're trying to turn everything into cash to pay down debt and stay liquid. But here's the problem with fire sales: you don't get good prices. When everyone knows you're desperate to sell, buyers lowball you. Vanke is likely selling assets at significant discounts just to generate cash flow. That means they're realizing losses on those sales too, which shows up in their financial statements. It's a negative spiral. They need cash, so they sell assets cheap, which creates more losses, which makes their financial position look worse, which makes it harder to borrow, which means they need to sell more assets. Round and round it goes. Their sales performance has been abysmal. Contracted home sales from January to September 2025 fell 44.6% year-over-year. Bloomberg Intelligence forecasts that their annual contracted sales could decline more than 40% to around 138 billion yuan. For context, in better years, Vanke was selling multiple hundreds of billions in properties. They've lost more than half their sales volume, and there's no sign of recovery. When your revenue collapses like that, it doesn't matter how much you cut costs. You can't cut your way to profitability when your top line is cratering. Now here's where it gets really concerning for global markets. Vanke isn't just some isolated case. They're a canary in the coal mine for China's entire economy. Real estate has historically accounted for about 25 to 30% of China's GDP when you factor in all the related industries: construction, building materials, furniture, appliances, home goods, real estate services, and more. When property crashes, it doesn't just hurt developers. It ripples through steel production, cement manufacturing, glass making, construction equipment, banking, and on and on. Millions of construction workers lose jobs. Millions of people in related industries feel the pain. Consumer spending drops because people feel poorer and more uncertain about the future. China's GDP growth has been struggling. Many provinces missed their growth targets in 2025. The government has been trying to shift the economy away from property dependence toward consumption and high-tech manufacturing, but that transition is proving incredibly difficult when property, which was such a huge part of the economy, is collapsing. You can't just replace 25% of GDP overnight with something else. It doesn't work like that. And here's the global connection that should worry everyone watching this video. China is the world's second largest economy. It's the largest trading partner for most countries in Asia, a massive importer of commodities from Australia, Brazil, and Africa, a huge market for European luxury goods and cars, and a critical part of global supply chains. When China's economy slows, when Chinese consumers stop spending, when Chinese companies stop investing, the whole world feels it. Australia's iron ore exports drop. Brazilian soy exports fall. German car sales decline. This isn't just China's problem. This is everyone's problem. For international investors, the Vanke situation is a warning. There are probably billions of dollars of Chinese developer bonds held in portfolios around the world, in pension funds, in mutual funds, in hedge funds. A lot of institutional investors bought these bonds because they offered higher yields than developed market bonds, and many assumed that state backing meant they were relatively safe. Vanke is proving that assumption wrong. State backing is not a guarantee. The Chinese government is not going to bail out every developer, no matter how big they are. Investors need to reprice risk across the entire Chinese property sector, and when you reprice risk, that means bond prices fall, yields rise, and losses get realized. We're also seeing implications for Chinese banks. A huge portion of bank lending in China goes to the property sector, either directly to developers or indirectly through mortgages. When developers can't repay loans, when homeowners are underwater on mortgages, when property serves as collateral for all kinds of loans, a property crash threatens the entire banking system. Now, Chinese banks are heavily regulated and controlled by the state, so we're not talking about a Lehman Brothers moment where banks start failing overnight. But we're talking about a significant rise in non-performing loans, pressure on bank capital ratios, and a general tightening of credit conditions that makes it harder for businesses to borrow and for the economy to grow. Looking forward, what happens next? Best case scenario, Vanke manages to restructure its debt, extends maturities, convinces creditors to take haircuts, and limps forward as a much smaller, less significant company. The Chinese government might coordinate a managed restructuring to avoid a chaotic default. They've done this before with other large companies. The goal would be to minimize systemic risk, make sure unfinished projects get completed so homebuyers aren't left holding the bag, and send a message that while things are bad, they're under control. Worst case scenario, Vanke runs out of cash, can't make debt payments, and formally defaults on a massive scale. Bondholders take huge losses. Construction stops on projects. Suppliers don't get paid, and some of them go under too. Homebuyers panic. The contagion spreads to other developers who are in similarly precarious positions. The Chinese government is forced to intervene with a much larger bailout program, which strains public finances and raises questions about moral hazard and whether they're just delaying the inevitable rather than fixing underlying problems. The most likely outcome is probably somewhere in between. Vanke will likely undergo some form of debt restructuring. Some creditors will take losses. The Chinese government will provide targeted support to ensure systemically important obligations are met and that social stability is maintained, because nothing scares the Chinese Communist Party more than the prospect of millions of angry homebuyers who paid for apartments that never get delivered. But the broader property market will continue to struggle for years. We're looking at a long, grinding adjustment, not a quick bounce back. For anyone thinking about investing in Chinese property or Chinese developer bonds, the message from Vanke should be crystal clear. Proceed with extreme caution. The era of easy money in Chinese real estate is over. The boom times aren't coming back anytime soon. Demographics are working against the market. China's population is aging rapidly. The working-age population is shrinking. Urbanization is slowing down. The demand drivers that powered the property market for 30 years are weakening or reversing. Overcapacity and oversupply are endemic. Too many cities built too many apartments chasing a boom that's now a bust. What does this mean for regular people, for you watching this video? If you're in China, it means being very careful about buying property right now. Prices are still falling. Developers are still failing. There's no rush to buy when everything is on sale, and likely to be even more on sale next year. Wait for genuine signs of market stabilization before making the biggest purchase of your life. If you're outside China but your country has significant economic exposure to China through trade or investment, it means watching for spillover effects. Slower Chinese growth means less demand for your country's exports. Chinese investors pulling back means less capital flowing into your country's assets. If you're an investor, it means being very selective about China exposure. Not all Chinese companies are in trouble, but the property sector is a landmine, and the property sector touches so many other parts of the Chinese economy that you need to be careful. Diversification matters. Don't put all your eggs in one basket, especially when that basket is showing serious cracks. The Vanke story is still being written. We don't know yet how this ends. But we do know this. One of China's largest and most respected developers is in deep trouble, losing billions of dollars, desperately trying to stay afloat, and the Chinese government is letting them struggle rather than immediately bailing them out. That represents a fundamental shift in how China manages its economy and its financial system. The message is, you're on your own. Market discipline is coming to China, ready or not. This is a massive story with implications that will reverberate for years. If you found this video informative, make sure to hit that subscribe button and turn on notifications because we're going to keep following this story as it develops. The collapse of China's property market is one of the biggest economic stories of our time, and understanding it is crucial for anyone trying to make sense of where the global economy is heading. Thanks for watching, and I'll see you in the next one.